Assalamu alaikum guys. So this is Haris again with another video on accounting. So now we'll be covering double entry in this video. I'll be starting from this accounting equation, linking it to the concept of double entry using these transactions below. As already explained you initially, any event that any event that has to do with money or monetary thing is referred to as a transaction. Any business activity, any monetary activity in a business is transactions. So all these are your examples of transactions. Now if you look at these transactions, so look at them really carefully. This equation, if you see for us first transaction, if you see started a business with 50,000 cash, so you'll have to identify that each transaction would have double effect on this accounting equation. Like there are two sides of the picture for every transaction, like it will be affecting this equation in two ways. Now how will it affect in two ways? So this we can discuss through these transactions that are listed below. So transaction number one, started the business with $50,000 cash. So if let's say we start business with 50,000 cash, so our accounting equation basically was 0 equals to 0 plus 0 before this transaction, before this first transaction. So when we started our business, the business got 50,000 cash. That cash which business has received is referred to as an asset for the business, because asset is the resource owned by the business. Now if the owner has provided this 50,000 cash to the business, now the business owns this cash and resource, so this is an asset for the business. So after this transaction our assets would become 50,000, right? But as I said, there would also be a second picture of this transaction. So we should ask ourselves, where are we getting this money from? So if the owner is investing this money, we'll increase the amount of investment of owner or the capital by 50,000, and our liability would remain zero. So guys, try to understand, after every transaction your accounting equation should remain satisfied. So if a business is getting $50,000 cash, so you should ask, now business owns this cash. Once business has got this cash, so now you should ask yourself, by who's providing this cash? If the owner is providing this cash 50,000, so you should increase the capital or the investment of the owner by 50,000. And let's say if any third person gives this amount, so you should increase the liabilities for the business, right? As I told you, you have to keep the affairs of the business and affairs of the owner separate. So up for the owner, we have made a separate account that is referred to as capital. Anything that owner invest into the business will pass through capital account. Now he's investing capital, oh sorry, now he's investing 50,000 cash, so we'll increase this capital amount by 50,000 and say now the assets of the business are also 50,000. So this is what a dual effect of every transaction is. Like there's a two phase to every transaction. Now if you look at took loan from Umair 30,000 via check, took loan. So if a business get this amount of loan 30,000, so now business would receive this 30,000 as well. So again the assets of the business would increase by 30,000. Now the business would have 30,000 in its bank account, so I can say bank, 50,000 cash. So if you add both of these up, the business assets now equal 80,000. And you should ask yourself, 50,000 was initially invested by the owner, as you can see in transaction number one. and now 30,000 they have received loan from Umair. So the liabilities of the business would also increase by 30,000, right? So agar business, if business is receiving anything, like business got money, got check, so that is also an asset for the business. But then you should ask yourself again, who is bringing in this check in the business? So now this is not the owner, this is the loan from Umair. So again, so this is your liability, so you should increase your liability by 30,000. Okay, now if you look on the third equation, bought machinery on credit from Mia mom for $1,000. Now machinery, business is receiving machinery, so machinery is also an asset for the business, as we have learned before. So again our assets would increase by $1,000. So now our assets would include $1,000 machinery plus 30,000 in its bank plus 50,000 cash. And now after third equation, see, is it related to owner or anyone? It's not related to owner, so our capital would still stay 50,000. But we have bought this machinery. Now again you should ask yourself, bhai, how are we getting this machinery? So we're getting this machinery on credit. Credit means like we haven't paid the money, we have just promised me a mom that we're going to pay you in the future $1,000. So this is also our liability. So now my liability previously was 30,000. If I buy machinery as well on credit for $1,000, so my liabilities would increase by $1,000. So my liabilities would now be $31,000. $31,000. And if you look at the fourth transaction now, bought computer paying via cash $10,000. So see, computer, business is getting computer now. So if the business is getting computer, again our assets would increase by 10,000, because this computer is also an asset for the business. $10,000. I think I mistakenly erased some of the things. So 50,000 and $31,000. Now if we buy computer, so our assets will increase by 10,000. So 10,000 we can write in bracket computer. We have already got machinery 1,000. Now you should also ask yourself, how are we getting this computer worth $10,000? So we are getting by paying cash. Now is it written that the business bought this computer on credit, or the owner is bringing this computer? No, then the business is buying this computer through its own cash that it has. So now this cash which the business owns already is also an asset for the business. So basically one particular asset which is cash would reduce for the business when it buys computer. The business already had some cash lying. Now they paid this cash amount, so the cash decreased. Cash is also an asset for the business. So if you pay cash to someone, your cash would decrease, so your assets would decrease. And after paying this cash, you received a computer. So computer is also an asset for the business, and if the business receives computers, so assets would increase. So we can say the effects nullify, because you are sacrificing one asset in order to receive another assets. So your bank amount would stay 30,000 still, but now your cash would reduce by $10,000. We had 50,000 cash previously, but now we paid $10,000 cash in order to buy computer. So my cash would be 40,000. Now, if you total it, this is $81,000. And if you total this as well, this would also be $81,000. So what has happened is your cash reduced by $10,000, but your compute, so you got another asset which is computer, so due to which your assets increased by $10,000. We didn't take anything from the owner, so the owner's investment stays the same, and we didn't buy anything on credit, so our liabilities also stays the same. So again, your accounting equation satisfies. I hope this is understandable for everyone. Now if you carefully, as obvious, as I'm always telling you, that each transaction has a dual impact, has sides to it, two sides of the picture to it. So if you see in this equation, the started business with 50,000 cash, right? So started business with 50,000 cash. So in this equation, if you realize, your assets are also increasing, all, and your cash is also increasing. Acha guys, so probably a screen froze. So bought computer paying via cash $10,000. This we have already clarified. It's like we are sacrificing one asset in order to get another asset. So our total asset stays the same. We haven't bought anything from the owner, so our capital stays 50,000, and we haven't bought anything on credit as well. So our liabilities stays $31,000. Our liabilities get, oh sorry, our accounting equation gets satisfied over here. Now if you go back onto equation transaction number one, so what's happening is, if you look, like I told you, there's always a dual impact, two sides of the story to every transaction. Now what's happening here, you should see how this each transaction is affecting this particular accounting equation in two ways. Now, if the we start off business with 50,000 cash, so the asset would increase, but alongside your capital would also increase, as you can see in this equation. And if you look at the second equation, business received check, money via check. So assets are also increasing here. But this time it was a loan from Omer, so your liabilities are also increasing. Also increasing. Now, if you buy machinery on credit from Mia Mom for $1,000, so again, machinery is an asset for you. So assets are increasing, but since you bought this on credit from Mia Mom, so your liabilities are also increasing in this. Now, if you look at the fourth equation, assets are increasing because you bought computer, but at the same time you paid cash in order to buy computer. So your assets are also reducing. So can I say your assets can increase when capital increase? Like you can see in equation number, transaction number one, your assets can increase if your liabilities increases, as seen in transaction number 2 and 3, or your assets can increase if your other asset decreases. Okay. Now this actually lays the basis of double entry system of accounting. So as I said, there are two sides of the picture to every transaction. So there are two effects, like you see, like you have seen in all of these transactions, assets are increasing, so capital is increasing, assets are increasing, so liabilities is increasing, assets is increasing, so the other asset is decreasing. So you record this dual effect in every transaction by the double entry system. Double entry system. You actually debit one of the item and credit one of the other item. Like you debit one effect and you credit one effect. For every debit you should have a credit. For every debit you should have a credit, right? So the way your accounting equation remains satisfied, account capital assets equals to capital plus liability, so your debit should always be equals to credit, right? That is also, this is double, and this is what double entry system is. Like if one thing is getting debited, the other thing will going to get credited. There's no meaning behind debit or credit. These are just Greek terms probably. We usually write DR and CR as a short form. So this means debit record actually, and this means credit record. So as I said, we have already learned in the previous slide that there are two effects of each transaction. So one effect gets debited and the other effects get credited. So now the accountants have developed their own ways, like which of the items would get debited and which item would get credited. So they've like logically come up with something. So what accountants did was, so they made a rule that if assets increases, they will going to get debited, right? Now if you see, asset is on the one side of the equation and capital and liabilities are on the other side of the equation. And if we have already learned, if asset is increasing, so our capital would increase. If assets are increasing, our liability would increase, right? We've already learned this. So if the increase in assets get debited, so in order to satisfy our double entry system, it is necessary for us that our capital gets credited. Similarly, if our assets increase in asset is debited, so similarly your increase in liability should be credited for you to satisfy both your accounting equation and double entry system of debit and credit. So can I say liabilities and capital, if they increase, they get credited. Okay. And if you if you can reverse this rules as well, if assets decreases, it gets credited, as we have already seen. See, this particular asset which is increasing will get debited, like machinery. We bought computer, so computer was increasing, so computer would get debited. But another asset is being reduced, which is cash. So cash is reducing, so cash would get credited. So that is what the double entry in accounting is. So if assets decreases, they get credited, and vice versa. If liabilities and capital decreases, they get debited. So basically, you just have to remember one rule, and the rest of them follows. If you just remember aid, assets, I for increase, and D for debit. So increase an asset is debited. So now you know the rules for liabilities and capital are reversed. So increase in asset would get debited. Increase in liabilities and capital would get credited. Now you know increase in asset is a debit. So decrease in this asset is credit. And so decrease in liabilities and capital would be debited, right? So guys, now we've got this double entries worksheet in front of us. So whatever concepts we have learned, we can recreate this through practicing from this worksheet. So I'll be attempting question number 2 with you guys, and you can try out question number 1 on your own. All my solutions are available for those who obviously knows me. Or they can, or others can even comment and all to get the solution and everything. So if you look at question number 2, so what I'll do is make I'll just make this thing called, like we'll be doing journal entries for these transactions. We'll be doing journal entries for these transactions. So whatever we have learned, we'll be following that. So first column is for date. This column is for date. The second column is for particulars. Particulars. And the first column is for debit, and the other column is for credit. Okay, so I will see the first transaction. So if you look at question number 2, 2009 June, I can write date here, 2009 June, and first started business with 16,000 in the bank. See, now if you're starting with the business, so what is now you have to ask yourself what is getting debited and what is getting credited, right? So if we start business with 16,000 in the bank, it has to do with two things: that business is getting money in its bank account, and who is bringing this money? The owner is bringing this amount of money. The owner is bringing this amount of money, right? So the owner is bringing this amount of money. So bank would get debited, and and capital would get credited by what amount? 16,000. So the rule here is whatever is getting debited should come in the first line, like I've written bank over here, because bank is an asset. Now, if the business is receiving money, its asset is increasing. So you should also ask yourself which asset is increasing. The name of that asset is bank. Now you'll have to write the name of the accounts as well. So your asset is bank. We are getting money in our bank account. So our bank is getting debited because bank is an asset and asset is increasing, and increase in asset is always debited. So that is why your bank is an asset and it is getting debited. And the investment of the owner in business is also increasing. So that is why, as we have learned, the rule increase in capital gets credited. So that's why we're crediting capital by $16,000. Now if you look at the second transaction, bought when, paying by check 6,400. So the business got van. The van is an asset for the business. So if asset increases, they get debited, so van will get debited. Paying by check, so the business paid this amount by check. So the business already had the money in their bank account, they pay through their bank account. So the bank is also an asset for the business, but this particular asset would decrease, the bank would decrease because they'll pay through bank. So bank would get credited because decrease in asset gets credited. This might be a little bit difficult for you, but if you give it a good practice, so you will get used to it easily. So when gets debited, whatever gets debited come in the first line, and bank gets credited, and whatever gets credited comes in the second line. The amount is 6,400. Now, if you look at the entry on 5th June 2009, bought office fixtures 900. So bought office fixtures 900 means office fixtures is an asset for the business. Now, if business buys office furniture, so their asset would increase. And which asset would increase? Office fixtures would increase. So that is why we're going to debit office fixtures by $900. Office fixtures would get debited by $900. But now you should ask yourself, how are they getting this office fixtures? They're getting it on credit from Ode Limited. So Ode Limited is your liability because you're buying on credit from Ode Limited. And if your liability increases, they get credited. So your Ode Limited would get credited by $900. And now entry number 8, bought when on credit from Carton Cars Limited. So this is very similar to the entry on 5th June. Bought van is an asset. Asset is coming in, so assets are increasing. Which asset is increasing? Van, and increase in asset is debited. So we're going to debit van. On credit from Carton Cars Limited. So since you bought this van on credit from Carton Car Limited, so Carton Cars Limited is a liability for the business. So Carton Car would get credited because the increase in liability gets credited. So van 7,100 and Carton Cars Limited also 7,100. Van 7,100. Carton Cars Limited also credited by 7100. If you read entry number 12th June 2009, took 180 out of the bank. Now, since they took 180 out of the bank, so this means the money from the bank account is reducing. Bank is an asset for the business, and if the money goes out of the bank, so the bank would get reduced, this asset would get reduced, so this means the bank would get credited because the decrease in an asset is credited. So bank would get credited and put it into the cash till cash is also an asset. So if we take out money from bank, so bank will get credited, but we'll have more of cash in our hand, so our cash would increase, and increase in the asset gets debited, so cash would get debited by 120. So cash 120 on 12th, and bank would get credited 120 on 12th. Now if you look at entry on 15th June 2009, bought office fixtures paying by cash. Office fixtures is an asset. So increase in asset gets debited. So office fixtures are coming in. So office fixtures would get debited. But now you should ask yourself the second effect, that how are you getting these office fixtures? So we're getting this by paying by cash. So cash would reduce if we buy these office fixtures, and cash is also an asset, and the decrease in asset gets credited. So office fixtures would get debited and cash would get credited by 120 on 15th. Office fixtures and cash would get credited by 120. What's the amount? Let's see. By 120. Sorry, the earlier amount in the entry was 180. Probably I was mistaken. This should be 180 and not 120. You can check the transaction again on the previous slide. Now, if we do other transactions as well, really quickly, 19th, paid Carton Cars Limited a check for 7,100. So now we are paying Carton Cars Limited a check for 7,100. So if we pay a check, our money in our bank account would decrease. Bank is an asset. So if asset decreases, that gets credited. So bank would get credited. But then what will going to get debited? So Carton Cars Limited will going to get debited. And why? Because you can see you had previously bought a van on credit from Carton Cars Limited. Now, if you pay Carton Cars Limited back, your liability would decrease. Carton Cars Limited was your liability. You had to pay back money to Carton Cars Limited, like the business had to pay back. So now when they pay back any amount to the liability holder, so our liability decreases. So Carton Cars would that's why get debited. Decrease in liability gets debited, and therefore Carton Cars would get debited. So what's the amount for Carton Cars? 19th, Carton Cars debited by 7,100 and bank credited by 7,100. Carton Cars Limited, bank 7,100. And now if you look on 21st, a loan of 500 cash is received from BBerry. So we are getting loan. So if you look at it, if you get a loan, your liability would increase, but since we're getting cash, so our assets are also increasing. So assets are increasing, and which asset is increasing? Cash. So you will debit cash by 500, and you will debit loan, or you, sorry, not debit, you will credit loan, because loan is a liability and liability is increasing. So you should credit loan, and loan from BBerry would get credited. So cash debit beta and loan from BBerry. loan from Bberry 500. Just last two entries. Paid 400 out of the cash in off the hand into the bank account. So now we are paying cash that we had in hand into bank account. So cash would decrease and bank would increase. So increase in asset gets debited. So that is why bank would get debited. Increase in asset get debited. So that's why bank would get debited. And decrease and cash is decreasing. So decrease in asset gets credited. So that is why cash would going to get credited by $400. So we can debit bank and credit cash. 25th, debit bank and credit cash, $400. Now just the last transaction, guys. Bought more office fixtures paying by check 480. So office fixtures is an asset for the business. Asset is increasing. Increase in asset gets debited. So your office fixtures would get debited. Office fixtures would get debited. But then you should ask yourself, how are we getting this office fixtures? Now, if you read out the transaction, we're getting office fixtures by paying via check 480. So our money in the bank account wouldn't decrease. And our bank is also an asset. So decrease in asset gets credited. So that is why bank would get credited. Bank would get credited by 480. So guys, we are done with our video on this as well. You can practice question number one on your own in order to see how well do you understand the concepts in this video. Thank you for thank you for watching. Allah Hafiz.